Two identical trawlers sit 2 slips apart in Punta Gorda, Florida. One owner pays $2,400 a year to insure his. The other pays $1,100 for the exact same coverage. Same boat, same water, same risk floating in the same channel. The only thing different is what each man knew before he signed. One made 8 phone calls. The other took the first number a fellow in a hurry handed him. Here's what nobody on that dock will tell you. Of every bill you pay to own a boat, the slip, the fuel, the haul out, insurance is the one with the most slack in it. It's the one you can grab by the collar and shake money loose from, and almost nobody does. I've spent more of my life under boats than on top of them, and I've watched more people overpay on insurance than on the boat itself. The new boat salesman won't walk you through it. He's got a man he likes to hand you to, somebody who'll write a fast policy so the sale closes before you sleep on it. The big company you call off a television ad quotes the headline number and moves on. They're just counting on you not knowing how much of that bill sits in your own hands. None of this is a trick or a loophole. It's 8 plain moves any owner can make, and stacked together, I've watched them cut a premium by 1/3, sometimes closer to 40%. The first 7 knock the bill down. The 8th decides whether you get paid or get pennies the day the boat's gone. Let's run them. On a standard cruiser, insurance runs about 1 to 1.5% of the insured value a year. So a $40,000 trawler lands around $400 to $600 if everything's in your favor, and 3 or 4 times that if it isn't. Push into a fast hull or a hurricane coast and the rate climbs to 3, even 5%. Coastal and storm states run 25 to 50% higher than an inland lake, and since the big blows of the last few years, the Gulf and Atlantic carriers have gotten picky. Some Florida owners are seeing 15 to 25% jumps on renewal alone. But here's the good news in all that. A bill built from a dozen moving parts is a bill with a dozen places to push back. And a diesel boat already insures cheaper than a gas one because there's less down in that engine room that catches fire. The AI boat channels miss this constantly. They throw out one flat insurance number like every boat in every state pays the same, and the old hands in the comments catch it every time. Move 1, and it's the biggest single dollar on the list. Call an independent marine specialist, not the giant you see on television. That's exactly where the man in Punta Gorda paying double went wrong. A boat policy is its own animal: salvage, wreck removal, fuel spill liability, agreed hull value, the named storm deductible, and a big general carrier treats it like a slightly damp car. A broker who writes nothing but boats shops a dozen marine markets and knows which company wants a 40-year-old trawler and which one punishes you for it. The spread between a specialty marine insurer and a general carrier runs 10 to 30% on the very same coverage. Same hull, same water, same you, a quarter of the bill gone for dialing the right number. Make the call yourself and get 3 to 5 quotes on the same limits. That one afternoon beats every other move on this list combined, but the next one's the cheapest money you'll ever make. Move 2. Take the boating safety course. I know. You've run boats since you were a boy and don't need a classroom. Doesn't matter. The course isn't for you, it's for the underwriter, who reads it as a man less likely to put a hole in something. A state-approved or Coast Guard auxiliary course earns 5 to 15% off, and I've seen carriers go to 20. Here's the part that ought to make you grin. A lot are free, and the rest run about $30 at the kitchen table in an evening. $30 one night. 10% off a $1,000 premium every year you own a boat. Nothing else in boat ownership pays back like that. Keep the certificate handy. They'll want it before they hand you the discount. The next move only works if your boat sleeps part of the year. Move 3. Declare a layup period. If you're up north or anywhere your boat spends a good stretch hauled out and shrink-wrapped instead of running, you're paying full freight for risk you don't have. A boat on jack stands in February can't hit a piling. Tell the company that. A layup endorsement suspends the running coverage, the part priced on you being out there using her, for the months she's parked while keeping fire, theft, and storm coverage live the whole time. That's another 5 to 15% off. You do have to declare it and honor it. Take her out during your stated layup and you've handed them a clean reason to deny a claim. So be straight about your real season. Cruise 5 or 6 months and store the other 6. And you're overpaying for a boat asleep under a tarp. One call fixes it. The next move you can do with a screwdriver and a free Saturday. Move 4, store her smart and let the boat tell on itself. A vessel in a covered, monitored, locked-up yard reads as a lower risk than one swinging on a ball in an open anchorage, and the discount runs 10 to 15%. Add the cheap hardware while you're at it. A GPS tracker, a battery cutoff, a simple alarm, gear that costs a couple $100 once, knocks off another 5 to 15% and pays for itself inside 2 or 3 seasons. A locked, tracked, tucked-away boat is one the company's less likely to cut a check on, so they share the savings to get you to do it. Think of it as a deadbolt that mails you a rebate every year. It just quietly trims the bill while making your boat harder to steal. The next move is the one your home insurance has been waiting on. Move 5, put your boat under the same roof as the rest of what you own. If you've got a home policy, an auto policy, an umbrella over the top of it, ask that same company what they'll do if you bring the boat in too. Bundling's the oldest discount in the book and it still works. 5 to 10% is common, and I've seen multi-policy credits hit 25 when the boat, the truck, and the house all sit with one carrier. But I'll be straight with you. Sometimes the specialist broker from Move 1 still beats the bundle even after the discount. A dedicated marine market can come in lower than your home company, so get the bundle number, get the specialist number, and lay them side by side. Take whichever's actually cheaper for the same coverage, not whichever's easier. Make them compete for you instead of the other way around. And if this is the kind of plain talk the man with the financing brochure will never give you, do me a favor. Tap that like button, then hit subscribe. I put out a couple of these every week, sometimes more, so there's always another boat on the way. Now, Move 6 is the one the big outfits hope you never ask about. Move 6. Set your deductible where it belongs. The deductible is what you cover yourself before the company pays a dime, and most folks set theirs low out of nerves. But every dollar you drop it raises your premium. Move from a $500 deductible up to $1,000 and you'll usually knock off 10 to 15%. Take it to $2,500 and you're looking at 20 to 25. The rule's simple. Set it as high as you can comfortably cover tomorrow morning and pocket the difference the rest of the year. Then ask for the disappearing deductible, because this one's almost a gift. Several companies shave a piece off your deductible for every year you go without a claim. One cuts it a quarter each clean year until it hits 0. So the longer you own the boat and stay out of trouble, the less a claim ever costs you. You're rewarded for the thing you were going to do anyway. Run your boat like a careful man. And the next move protects exactly that. Move 7, guard your claims-free record like it's cash, because that's exactly what it is. After 3 to 5 years with no claims, most companies hand you a 10 to 20% break, and it grows the longer you keep it clean. Here's where men throw it away. They tap the dock, scuff the gel coat, crack a $400 piece of trim, and they file it on a $500 deductible where the company pays them nothing and then nudges their rate up at renewal for the trouble. Don't. If a repair's anywhere near your deductible, pay it yourself and keep your record spotless, because that clean record is worth far more over the years than one small check. While you're at it, 2 easy ones. Pay the year up front to dodge installment fees, good for 2 to 10%, and if you're the first owner to title the boat, some companies knock off 5. Small stuff. Stacked over a decade, it's real money. Now here's the one move I'd never let you cut. Move 8 isn't about paying less. It's about making sure the money you do pay ever comes home to you. And it's the one corner on this whole boat I won't let you trim. You get one of 2 kinds of policy, and the names are dull enough that nobody reads them. Actual cash value pays you what the boat's worth the day it sinks, minus every year of depreciation, so a total loss hands you a fraction of what you thought you had. Agreed value pays the full number you and the company wrote down the day you signed. No depreciation, no argument. Agreed value costs 10 to 20% more up front. Pay it. On any boat worth more than $30,000, that extra slice is the cheapest insurance you'll ever buy on your insurance. The whole point of the other 7 moves was to keep money in your pocket, and actual cash value quietly cancels every bit of it the day you need the policy to work. The AI channels love to tell you the two are the same. They are not. Read the word agreed on the front page before you sign anything. So there's your 8. Call a marine specialist, not the television outfit. Take the safety course. Declare your layup. Lock her up and tag her with a tracker. Lay the bundle against the broker and take the cheaper one. Set your deductible high and let it disappear. Pay your small dings yourself and keep your record clean. And never trade away agreed value for a few dollars off. Here's what I'd do with my own boat and my own money in order. 1. Make the specialist broker call first because it's the biggest number on the page. 2. Knock out the free safety course that same week. 3. Set the highest deductible I could cover without flinching and ask for the disappearing kind. 4. Write agreed value on the application in my own hand. Do those 4, stack the rest where they fit, and you'll cut that renewal by a third without giving up an inch of the coverage that matters. I made a playbook and put the whole buy it, own it, and insure it system in writing. Every move and every number, all the questions to ask before you sign. The link to the playbook is below for less than a marine broker charges for an hour on the phone. There's one more piece I haven't touched, the one that catches good people off guard. It isn't what your insurance costs. It's the fine print that decides whether they ever pay you at all. The named storm deductible that's secretly a percentage, not a flat number. The navigation line that voids the whole policy the day you cross it. The survey they'll demand on an older boat before they write a word. I'm taking all of it apart in the next one, so hit subscribe and you'll catch it the day it goes up. Until then, don't let anybody rush you into the cheap policy or the fast one. The right coverage will still be there after you've made your 8 calls, and so will your money. Don't let anybody hurry you off that dock, and don't let them hurry you onto the first policy either.